Hey guys, welcome back to the channel. I actually want to talk about a move I just recently made in my portfolio, and I actually sold Apple. I know, one of the biggest companies in the world. I replaced it with a company called S&P Global. I'm going to walk you through exactly why I made this decision. Now, this isn't a decision I made lightly. Apple's been a decent position of mine, making up about 5% of my portfolio, but when I really started looking at the numbers and thinking about the future growth potential, it just made sense to sell them because of their valuation. I'm going to be talking about that here pretty soon. So Apple's currently valued at over $3 trillion, and that's a massive market cap, but the revenue is only growing at around 4% year over year, and that disconnect between their size and their growth rate has started to concern me. And this chart right here kind of shows that. The orange is their market cap, and the blue is how their revenue is changing year over year since 2006. And you can just see that their revenue change year after year is slowing down. In fact, 2023 went down. Just look how big that market cap has gotten. And we're going to be dissecting this a little more later on. When I invest in companies, I'm looking for businesses that can compound their wealth over time. I'm only 19. I have a long time horizon, and this means I can take on more risk than others. And I don't want to play it safe with like dividend stocks or focus on like preserving capital. And when I see a company slowing down like Apple, I'm going to jump in and change my portfolio. I can afford to be a little bit more aggressive, but I also make sure that I'm having quality companies in my portfolio. But even with my high risk tolerance, I still have specific criteria. I want companies with a strong moats, operating leverage, pricing power, and their free cash flow just grows year after year. I'm willing to pay up for quality companies because I have time to let them compound. When you're young like me, your biggest asset is time, and you can really have your portfolio compound over time like this. My portfolio has gone down lately, but I'm not really worried because I'm in it for the long haul, right? So I started to ask myself, does Apple still fit this criteria? And when I looked at their business segments, I saw their hardware sales, which make up most of their revenue, have only been growing at about 3% annually. And the service segment's only growing at around 11%, which is what most investors are keeping an eye on. In fact, if we look here at this chart, you could see that their revenue is, like I said, slowing down, only growing about 2% year over year. And that's mainly due to the service segments like Apple Music and that kind of stuff, the add-ons they do. In fact, if we look at this chart right here, you can just see that their hardware sales in the last 2 years have actually gone down in revenue, which is concerning. And if we look at their services, it is going up, like I said, about 11% year over year. But it's going to be this segment of Apple that's going to continue their growth. And honestly, I just don't know if services is Apple's thing because it just doesn't make up a huge portion of their revenue yet. And there's other concerns I'm going to mention on later, but it's just one thing to keep your eye on. Apple also faces an increasing competition in smartphones. Samsung has actually regained the lead globally, like percent market share compared to Apple's 18%. In China, Apple's market share has fallen from 18% to 12%. As companies like Huawei, I'm probably pronouncing that wrong, have gained ground. And something that just really concerns me about Apple's China situation is Huawei and Xiaomi aren't just regular competitors, they're Chinese companies with strong government backing. China's pushing for technological self-sufficiency, especially after the US sanctions on Huawei. I don't even know if I'm pronouncing that right, so I apologize if I'm not. The Chinese government wants their citizens using Chinese phones, with Chinese operating systems, not iPhones. In a communist country like China, the government has enormous influence over the market. They can implement policies that favor domestic companies and make it harder for foreign ones like Apple. We're already seeing this happen with various government agencies in China banning iPhones for work. And the geopolitical risk isn't going away anytime soon, in my opinion, and it could be seriously limiting Apple's growth in which should be one of the most important markets. And in India, which is one of the markets where the phone is expanding, Apple only has about 5% market share. That's way behind competitors like Xiaomi. I don't even know. I'm sorry if I'm not pronouncing that right. And Vivo, which has about 21%, 18% respectively. And the premium pricing strategy that works so well for Apple just isn't working well in these expanding markets where the phone's becoming more popular. Instead of Apple, their premium is more of a US/Europe thing. So it's one thing to keep in mind. And like I said, I did just trim it and I put it in S&P 500 or S&P Global. Another huge concern I have about Apple's scalability going forward is where they're going to go. They've developed markets like the US and Europe have already saturated with iPhones. Almost everyone who wants an iPhone can afford one already, and that's why we're seeing longer upgrade cycles. People are keeping their phones for 42 months now instead of 36 months, which is what we saw a few years ago. And in emerging markets, there's actually growth potential, like I mentioned earlier. Apple's premium pricing is a major obstacle, and they face kind of competition when it comes to that, and they have limited market share, and neither option is great for the long term, in my opinion. And even Apple's new product categories haven't been that impressive. The Apple Watch, it was successful, but nowhere near the scale of the iPhone. The HomePod struggled, the AirPods are great but face increased competition, you can easily find replacements. And the Vision Pro, while technically impressive, it's too expensive for mass adoption for the average person. So I just don't see where Apple's massive growth is going to come from. Also, when I look at Apple's wearable market, I see signs of slowing growth. In fact, one of my companies, Garmin, which I like a lot more, is gaining market share in this, and Apple's losing it. And I talked about Garmin in one of my earlier videos, and after their earnings about a couple weeks ago, their stock went up. And you can see in this chart right here, the blue is Apple's revenue, just keeps going down year after year change. And Garmin, for the last few years, they've gone up a lot, increasing their revenue by 20% the previous year, which is what I really like to see. So don't get me wrong, Apple is an incredible company. They have loyal customers, they have this beautiful ecosystem, but at a current valuation of around 40, which their 10-year average is around 22, I started to feel like potential for future returns just wasn't there. And they have a $3.7 trillion market cap, the biggest company in the world, and they're only growing their revenue by 2% in their hardware sales. To me, it's just a little bit concerning. Also, it's not even just me. Warren Buffett and his Berkshire Hathaway recently sold about 15% of their stake on Apple. They still hold a lot of it, but they are doing a bigger cash size, probably protecting their future profits. Let's talk about Apple's free cash flow, which is something I focus on heavily. The free cash flow yield has dipped to 3.8% in 2024. I think it's lower than that, down from 5.2% in 2020. For a company this size, that's not terrible, but it's not exciting either. And a dividend yield of just 0.4%, which is well below the S&P 500 of 1.6%. I'm not getting paid much to wait for growth to accelerate. So essentially, it's a slowing business, and their dividend's not even great, so why even invest? Now, I know some might be thinking, what about Apple Intelligence, the AI stuff? And I thought about that too, and Apple did finally launch their Apple Intelligence in 2024, and it does have some cool capabilities. However, I think it's worth noting that Apple still trails ChatGPT when it comes to accuracy and just the sheer results of that, and including. However, I think it's worth mentioning that Apple still lags behind things like ChatGPT and Gemini, Copilot. They don't even come close when it comes to testing, so I just want to point that out. So only about 60% of active iPhones can even support Apple Intelligence. That means a huge portion of their installed base can't use these features, which delays the ecosystem adoption, in my opinion. So for Apple Intelligence to drive meaningful upgrade cycles, it would have to be so incredibly good and revolutionary compared to competitors that people would rush to upgrade their phones to just use it. We need to see that powerful word of mouth effect where people are showing their friends, look at what my iPhone can do that yours can't. And honestly, I just don't think Apple's doing that right now. And that's another reason why I sold it. So when I put this all together, the slowing growth, the competitive pressures, the high valuation, and the uncertain AI roadmap, I decided it was time for a company with better long-term prospects, and that's when S&P Global caught my attention. If you're not familiar with S&P Global, they're basically a financial intelligence powerhouse. They own the S&P ratings business that rates debt for companies and governments. They also provide data, analytics, and indices that are crucial to financial markets. And what really attracted me to S&P Global is their moat. They operate in a duopoly with Moody's in the credit ratings market. When companies need to issue debt, they need these ratings. And the trust and reputation these agencies have built over decades creates a massive barrier to entry to competitors. In other words, it's kind of just hard to enter this market. And with big names already with Moody's and S&P Global, and the more rating of debt they're going to do, it's going to create a larger moat for them. So this is the kind of moat I love to see in companies. While Apple, they constantly innovate and fight off competitors in the hardware space, S&P Global has a much durable competitive advantage, and their brand reputation and credit ratings has particularly been impossible to replicate. And unlike Apple, which faces direct competition from Google, Samsung, and these Chinese companies, S&P Global has a clear runway for growth. They don't have to worry about the next hot smartphone taking market share or consumers delaying upgrades. Looking at the fundamentals, S&P Global looks pretty good. They're growing their revenue in the last few years on average about 5 to 7%, and their margins are about 47%, and they're expanding their services with AI and data analytics too, which should fuel growth for years to come. This chart right here shows the operating margin of S&P Global. You can see it's been going up and up and up since 2021, and then it went down, and then it's starting to go back up again. But when it went down, you have to understand they made a tuck-in acquisition that just helps with their data analytics business and just makes them more strong and more of a competitive moat. So out 3 to 5 years from now, I do believe S&P Global is going to outperform the market, aka the S&P 500. So S&P Global's ESG analytics revenue hit 600 million in 2024 and grew over 40% year over year. That's the kind of growth I want to see, unlike Apple, and it's being driven by structural changes and how businesses operate and report an environmental impact. Another thing I really like is that about 7% of S&P Global's revenue comes from subscriptions and asset-linked fees. This creates predictable, recurring revenue streams with high customer retention rates above 90%, which is the kind of stability I want to see in long-term holding. Also, the global corporate debt rate by S&P Global reached nearly $24 trillion. That's with a T. In July 2024, which was up like 3.3%, and their debt specifically grew 4%. This growth, fueled by interest rates and refinancing needs, directly benefits S&P Global's ratings division. Their management is projecting 2025 build insurance growth of about 5 to 7%, which translates to $350 to $400 million in incremental ratings revenue. That's, to me, that seems like serious growth potential, and the market isn't fully appreciating it, in my opinion. I'm also impressed by how S&P Global is leveraging AI to improve their own operations. They launched something called Automated Data Ingestion (ADI) within their iLevel platform, which uses AI to streamline data extraction from unstructured documents. This reduces manual processing time by like 70% for asset managers. They also acquired a company called Proto NLP in December 2024, which is going to help with their AI capabilities. And it just helps with the financial structure and how they can rate things. And while Apple talks about AI, SP Global is actually implementing it, in my opinion, in more ways than Apple, which a lot of people would not agree with that, but it's my personal take. Also, this chart shows their earnings per share growth over time. You can see in 2023, they're growing it a lot. In fact, in the last year, they grew it 50%. And I do believe it's going to be $20 per share and probably in the next couple years. I look for companies that can grow their earnings per share about 15% year over year, just for a safe performance in the long run in the S&P 500. I think S&P Global is definitely going to do that. This chart right here shows S&P Global's subscription revenue, which is that predictable revenue I like to see. And you can see it's just been going up over time. And it's just one thing to point out. Now, just to talk about valuation, here's the forward PE ratio of these two companies since around start 2021. S&P Global trades at about 31.5 times forward earnings, which isn't cheap, but when you consider their 8.3% EBITDA growth rate and 20% return on equity, I think that premium is justified. Compare that to Apple at nearly 40 times PE with slower growth. S&P Global's chart starts to look like the better value. S&P Global actually trades at about a 12% discount to a DCF fair value, according to some analysis, and the current price is around $525, but fair value estimates can go up to around $580. So that's just suggests more room growth for S&P Global. I should mention that S&P Global isn't without its risk, just like with any investment. The ratings business is cyclical and depends on debt volume, which can fluctuate with interest rates. But I do believe their diversification across multiple business lines does make it an appealing investment. If you like dividends, I think you're also going to like S&P Global because their they've raised their dividends for like 53 straight years. In the last 5 years, it's on average gone up about 10%. So that's really good for a company of this size. So to talk about S&P Global's free cash flow, they had $5.2 billion in 2024, which you can see right here. And it supports both dividends and a significant buyback program. They have $4.3 billion remaining in their buyback authorization, which is enough to shares outstanding by about 3% annually. And that's the kind of capital I love to see in companies like this. And about management, SP Global actually got a new CEO in Q4 2024. Since taking over, I don't know what her name, but she's accelerated AI investments while maintaining cost discipline. Her 2025 guidance of 5 to 7% revenue growth and $17 to $17.25 earnings per share, which is a 21% year-over-year increase. That just signals confidence in SP Global's innovation pipeline. So let me circle back to why I made this swap. Both positions make up about 5% of my portfolio, so it's just a direct swap. And I just think S&P Global gives me better exposure to financial markets and it adds more diversification to my portfolio because honestly my portfolio was kind of tech heavy and I just like the business model of S&P Global. I'm not saying Apple's a bad company. I think they're far from it. It's one of the greatest companies ever built. You can't argue with that, but at $3 trillion market cap and single digit, just think there's better placements for my capital and S&P Global kind of fits the bill and it fits my investment philosophy, so that's why I decided to buy it. So when I first started investing, I think you tell me I'm crazy to sell Apple, but because it's a household name, the products are incredible and everyone knows about it. But as I've learned more about investing and developed my own strategy, I've realized that sometimes the most popular companies aren't the best investments. So what matters more than popular in businesses is just finding businesses with durable competitive advantages, with strong moats that can grow your money in a long time period. I believe S&P Global can definitely do that for me. So let's give you an example of just Apple's tremendous valuation. If Apple wants to grow revenue by 10% next year, it would need to add about $40 billion in new sales, and that's roughly the size of a Fortune 100 company. The law of large numbers makes this difficult for a company of Apple's size. Meanwhile, S&P Global would only need to add about 3.5 billion to achieve the same percentage growth. That's much more achievable, especially with tailwinds they have in areas like ESG analytics and debt and issuance. I also want to touch on something that I think is really important for young investors like myself and probably many of you watching this. We have time on our side. That means we can afford to be patient and let compounding work its magic. But for compounding to truly be powerful, you need to invest in businesses that can sustain high growth rates for many years. Apple's growth has slowed, which is natural for a company of its size, but it might not be the best choice for a young investor with a multi-decade timeline like myself. S&P Global, on the other hand, is positioned in markets with long runways for growth. The shift to passive investing and the increasing complexity of financial markets, it's just all these trends benefit S&P Global for years to come. And I think they're trading at an okay valuation right now. So to summarize why I made the swap, I sold Apple because despite being a great company, its massive size and slowing growth made me question its ability to continue compounding at rates that would justify its current valuation. I bought S&P Global because of its strong moat, predictable recurring revenue, and better growth prospects in areas like ESG and AI-driven analytics, right? And S&P Global, it could definitely be a $1 trillion company in the future, easily. So the decision aligns with my personal investment philosophy. Your strategy might be different, and that's totally fine. We're all on this investing journey together. So I'm curious to know your thoughts in the comment down below. If you own any of these companies, either two, if you're bullish or bearish on them, hit the thumbs up. It only takes a second. It helps small YouTubers get out in the algorithm. So it'd mean a lot to me if you could do that. And that's going to be it for this video, and I'll see you in the next one.